Money has always felt like something simple. You work, you get paid, you spend on the needs of life, and whatever you do not spend becomes savings. That savings represents the time, effort, and discipline you put into earning it. Most people never stop to think about how their money is structured. What actually gives it value, or what allows it to hold purchasing power over long periods of time? We trust the currency because everyone else trusts it. We use it because everyone else uses it. It becomes so normal that we forget there is an entire system working underneath the paper in our hands and the numbers in our bank accounts. That system decides not only how much our money buys today, but whether it will still buy anything meaningful tomorrow. Behind every modern currency, there is a mechanism that determines whether money behaves like a reliable store of value or like something that melts slowly over time. One of the most overlooked parts of this mechanism is something called the gold cover ratio. It sounds technical, almost like a term reserved for bankers or economists with complex models, but the real idea is surprisingly clear. The gold cover ratio compares the amount of physical gold a nation holds to the total amount of money circulating in its economy. In other words, it asks a simple question. If all of the paper claims people hold were to be exchanged for gold, how much of those claims would have anything real behind them? Thousands of years ago, money was not a promise. It was a thing in itself. A coin did not merely represent value, it was the value. When a silver coin was handed over in payment, the metal inside it was the payment. The same was true of gold. No one needed to ask what backed it. You were holding the backing in your hand. A merchant in one city did not need to trust the government of another country to accept their coins because the metal itself carried universal worth. It did not matter who issued it. It did not depend on political promises. The value came from physical scarcity, from the fact that gold and silver were limited, difficult to extract, and impossible to create with a printing press. As trade expanded across regions and continents, using heavy metal every day became inconvenient. Carrying large amounts of gold or silver was risky and burdensome. Governments and banks developed a simple solution. Instead of carrying the metal itself, people could carry a paper receipt that promised a specific amount of metal stored safely somewhere else. At first, these receipts were just substitutes. A note was not money in its own right, it was a claim on money. If someone doubted its worth, they could take it to a bank and exchange it for real metal at a fixed rate. That ability to redeem paper for metal was what made early paper money trusted. Each note was a ticket to something tangible. The money supply could only grow if there was more gold or silver to support it. For a long period in history, this system held governments accountable. A ruler or a central bank could not simply print unlimited notes. Because too much paper compared to the gold backing, it meant that people would start redeeming notes for metal. If too many people did that, the gold in the vaults would run out. The government would then face a crisis, lose trust, or be forced to stop printing. In this way, precious metal served as a leash on political decisions. Leaders had to think carefully because they could not spend more than their reserves allowed. Money creation was tied to something physical, not just policy decisions or political convenience. But human nature is predictable when there is power involved. When governments felt they needed more money than they had gold or silver, they started to print more paper than they could redeem. They did it to finance wars, to build nationwide projects, to bail out struggling economies, or to avoid unpopular choices like raising taxes. It rarely happened all at once. Instead, it began with just a little extra paper. Most citizens did not notice the difference because daily life continued normally. Trade flows continued, prices moved slowly. The paper still looked and felt like money. And because the currency still worked, the government saw no immediate consequence. That made the temptation even stronger. This is where the gold cover ratio slowly began to weaken. The amount of gold in the vaults did not keep pace with the growing supply of notes. The public continued believing they could redeem their notes for metal. But in reality, there was less gold supporting each unit of currency. The system leaned more heavily on trust rather than scarcity. Nothing seemed wrong at first, because as long as people did not rush to redeem their notes, the illusion held together. Confidence acted like glue. As long as the glue remained, the gap between real metal and paper claims could grow. The gold cover ratio gradually became more important as a signal rather than a rule. It told observers how much of the currency could, in theory, be backed by gold. When the ratio was high, like it often was under strict gold or silver standards, the currency required very little trust. The metal did most of the work. As the ratio moved lower, trust became more essential. The state's credibility, its ability to manage debt, tax its people, and honor obligations became the true foundation of value. Paper money stopped being a claim on metal and instead became a claim on the future productivity of the nation. Even after most countries left a strict gold standard, their gold reserves still mattered as a confidence marker. Nations with large gold holdings projected stability. Investors and foreign governments saw it as a sign that the country could, at least symbolically, honor its debt with something tangible. The gold itself was like a financial anchor, even if the currency was no longer tied to it directly. Money became a mixture of belief, economic performance, tax capacity, military strength, and international influence. The gold cover ratio was no longer the law, but it remained a reminder of how disconnected a currency might be from physical value. Modern people rarely think about this. We grow up in a world where money is digital, where most wealth is numbers on screens, and where we assume governments always control inflation, interest rates, and policy. We assume the financial system will work because it has always worked during our lifetime. Few people consider how much their currency depends on confidence, or how confidence can shift when debts grow too large or money creation accelerates faster than real economic output. A currency backed by faith rather than metal can still function extremely well. In fact, the modern global economy could not function without fiat money. There simply is not enough gold to support the level of transactions, trade, and growth that exists today. But reliance on trust introduces new vulnerabilities. It means that value can be influenced by political crises, economic downturns, mismanagement of debt, war, sanctions, or even short-term decisions made by central banks. When confidence is strong, fiat currency is powerful. When confidence is questioned, that same currency can lose purchasing power rapidly. The system works beautifully until it is taken too far. When governments run large deficits year after year, when central banks are pressured to stimulate economies repeatedly, and when voters demand services and benefits without accepting the taxes to pay for them, paper money becomes easier to print than real solutions. Debt rises because it buys time. Printing rises because it avoids immediate pain. The ratio between physical reserves and circulating money drifts lower, and the gap between real value and perceived value widens. Most people do not notice the early stages because the effects appear slowly. Prices rise, but not dramatically. Currencies weaken, but not overnight. The signals come as subtle erosion instead of sudden disaster. If there is one lesson from centuries of monetary evolution, it is that money does not collapse simply because the public is ignorant. It collapses when confidence is tested and the underlying structure is too fragile to withstand the test. A system with high coverage, even if imperfect, can survive shock. A system with little coverage, whether it is backed by metal or by debt and taxation, must rely entirely on belief. As long as belief holds, the currency stands. When belief falls, the currency must adjust, sometimes sharply and painfully. Understanding the gold cover ratio today is not about predicting collapse or promoting fear. It is about realizing how money has changed, how its foundation moved from physical scarcity to policy and confidence, and how this shift introduces new forms of risk. It reminds us that the value of our earnings is not guaranteed simply because we have worked hard. It depends on decisions made far above us, in institutions that manage debt, taxation, spending, and issuance. It depends on what backs the currency now, and what people believe will back it tomorrow. The evolution of money shows that value is not destroyed randomly. It moves from those who assume paper value is permanent to those who recognize that money is a claim, not an object. The gold cover ratio teaches us that the strength of a currency lies not in what it prints, but in what it represents. It reveals whether money is a symbol of stored production or a promise that depends entirely on trust. And once we understand this, we see money differently. We see it not as simple paper, but as a contract between a nation and its citizens, a contract that must be honored for value to survive. When we observe history carefully, we begin to notice that financial systems do not usually fail because people suddenly stop believing in money. They fail because governments, institutions, and central authorities slowly erode the underlying trust without realizing how fragile it has become. Confidence is not a light switch that turns off instantly. It is more like a rope that frays fiber by fiber until one day it can no longer hold weight. The gold cover ratio is one of the clearest indicators of how Much strain a currency can withstand before that rope becomes dangerously thin. The story of ancient Rome shows that money does not fall apart when the metal content is slightly reduced. Nero did not destroy the denarius overnight. The public did not immediately panic when silver purity dropped from 98% to 93.5%. Few citizens even understood the change. Commerce continued, markets stayed open, and life looked normal. That is the deceptive part of monetary decay. It is slow. It is almost invisible to the average person. It does not show up as panic at first. It shows up as a gradual decline in buying power, a subtle shift in sentiment, a background discomfort that grows over generations. The emperors who came after Nero did not think they were doing something dramatic or dangerous. They simply wanted more money to pay troops, build monuments, or support the expanding military machine. Debasement felt like a harmless solution because it provided immediate relief at the cost of distant consequences. The Roman government treated money as a tool of convenience, not as a foundation of stability. By the time purity fell below 5%, the coin looked the same, it carried the same inscriptions, and it legally represented the same value, yet it no longer commanded trust. Merchants demanded more coins for the same goods. Soldiers felt cheated by their pay. Citizens avoided new coins and hoarded older ones. The currency still existed, but it no longer functioned as a reliable measure of value. A monetary system cannot survive when value becomes questionable. France in the late 1700s tells a similar story but with a different kind of backing. Unlike Rome, which relied on precious metal, revolutionary France attempted to create a currency backed by confiscated land. At first, this seemed brilliant. The land was real, valuable, and abundant. Paper money appeared to have something tangible behind it. People welcomed the change, believing it was a modern improvement. But a currency backed by physical assets only works if the asset supply and the note supply move together. As soon as the government printed more notes than land could reasonably support, the system began to crack. The interesting part is that, just like Rome, the collapse did not begin when the coverage slipped a little. It began when politicians realized they could issue more notes to solve every problem. Once printing turned into a political habit, confidence had no physical anchor. By the time the inflation became unbearable, it was no longer about economics. It turned into panic, anger, and a breakdown of trust in the entire state. The money itself was not destroyed. The belief in the fairness of the system was destroyed. Without confidence, currency becomes paper, even when the underlying assets still exist. The British example from the 1930s teaches yet another lesson. Great Britain did not collapse as France did. It did not lose everything like Rome. It did not face wheelbarrows of useless money. Instead, it faced a silent, technical crisis triggered by math rather than riots. When Britain returned to the gold standard at an unrealistic price after World War I, its gold reserves could not support the amount of money tied to that price. Investors noticed the mismatch, not the citizens. Banks and foreign governments requested gold rather than paper. As gold quietly drained from British vaults, the cover ratio declined until confidence reached a tipping point. Finally, Britain suspended gold convertibility. The pound did not vanish. It did not become worthless. But it lost credibility as the world's reserve currency. The position passed to the United States not through war, but through a ratio that no longer worked. Germany's hyperinflation after World War I shows how extreme the problem can become when debts and printing spiral out of control. Economists often blame war, reparations, or irresponsible printing. While all of those contributed, the true mechanism behind the collapse was loss of coverage and loss of confidence. Germany still had gold. It still had factories, farmland, people, and skills. The underlying economy did not disappear. What disappeared was trust that the paper mark represented any meaningful slice of that economy. When a nation prints more claims on value than the value itself, the math eventually forces one of two outcomes. Either the claims shrink in worth, or the assets must be sold to support them. Germany's decision to print instead of restructure led to the first outcome. The currency fell until it no longer represented real value. What these four historical examples show is that money does not require gold to work, but it does require a credible relationship between currency issued and real assets behind it. It also requires rules or discipline to prevent the issuing authority from overextending. The gold cover ratio is not just about metal. It is a measure of whether money creation is tied to something finite or something infinite. If money creation has no limits but real assets do, then the ratio between real value and printed value must eventually weaken. Whether a currency is backed by metal, land, taxation, or debt, the logic remains the same. If claims on value grow faster than value itself, the currency becomes vulnerable to mistrust. This brings us closer to the modern world, where currencies do not need physical backing to function. They operate on a combination of economic performance, monetary policy, debt management, and global confidence. Unlike Rome or France or Germany, modern governments use central banks. Interest rates, lending policies, reserve requirements, and international trade agreements to stabilize money. The key difference today is that money no longer reflects a pile of gold or farmland. It reflects our shared belief in the future productivity of a nation. When the world trusts a country's institutions, its currency acts strong, even with little physical coverage. When the world questions those institutions, coverage matters more than ever. In our current era, the gold cover ratio is no longer a legal rule, but it still acts like a thermometer. It does not control the system, but it measures how disconnected money has become from tangible value. Today, most governments issue currency backed by taxes, assets, laws, contracts, and economic output. Gold is no longer the anchor. Yet gold remains a signal, a reference point, a reminder of scarcity. When a world filled with unlimited digital money compares itself to a metal that cannot be printed, the contrast reveals what is stable and what is vulnerable. People often misunderstand this and assume that a low coverage ratio means collapse is certain. That is not true. Modern systems are more complex than ancient ones. A currency can survive with low metal backing if citizens and global markets continue to trust its government, its military strength, its productivity, and its ability to manage debt. The danger is not the low ratio by itself. The danger is when a low ratio meets declining confidence. That combination is what history warns us about. Confidence can support a currency for decades, but when doubt spreads, even slowly, the ratio shows where the limit lies. When governments take on larger debts year after year, when central banks are constantly asked to rescue markets, when deficits grow faster than national output, and when money creation becomes a constant economic tool, the future backing of currency becomes uncertain. People do not immediately panic in such situations. Instead, they adjust quietly. They buy fewer long-term bonds. They look for real estate, commodities, or businesses that generate value regardless of policy. They diversify into assets outside their home currency. They shift savings into foreign currencies or instruments tied to scarcity. They do not flee the financial system. They reposition within it. Confidence does not disappear instantly. It redistributes. As this redistribution happens, the perception of money transforms. A paycheck becomes something to convert rather than store. A savings account becomes a temporary parking spot rather than a long-term plan. Investments become not just sources of growth, but places to escape depreciation. When this mindset spreads across a society or across the world, the currency is still being used, but it is no longer the final destination of wealth. It becomes a transit tool, not a store of value. This is how monetary transitions happen without obvious collapse. The currency still exists, but its role changes. If there is a single lesson from the transitions of Rome, France, Britain, and Germany, it is that money remains stable only when the people believe that the issuing authority can and will uphold its responsibilities. This belief may come from gold, from military strength, from institutional discipline, or from global reliance on a reserve currency. But if the issuing authority weakens its discipline or its ability to maintain long-term value, the belief begins to shift. Money does not fail because paper stops printing. It fails when paper promises stretch too far from the underlying value they represent. A modern economy may not need gold to function, but it cannot survive without credible constraints. Without constraints, debt becomes the default solution to every political and economic challenge. And when debt must be rolled over repeatedly, money creation becomes a requirement, not a choice. At that point, a currency's value rests on simple trust that the system will continue, that others will keep using it, and that the claims on future productivity will eventually be paid. The gold cover ratio is a reminder that confidence has limits. It does not predict the future. It simply reveals how far a system has moved from tangible value and how much pressure that confidence rope can bear before it frays. If we stand in the present and look backward through financial history, it becomes clear that currencies do not simply represent numbers. They represent trust, rules, discipline, and faith in the future. When trust is strong, money works as a store of value. When trust weakens, money becomes a temporary tool used only because something better is not yet available. This same concept applies to every currency we use today, no matter how modern, digital, or technologically advanced it becomes. Money has evolved, but the human psychology behind it has not changed. People want something that preserves the effort of their work. They want something that holds value across time, not just at the moment they receive it. Although we live in an age that has moved beyond gold standards and metallic backing, the fundamentals of value remain. Digital banking, online transfers, electronic wallets, and instant payment systems do not change what money represents. They simply change how money moves. Whether we wave a smartphone at a supermarket checkout or slide a piece of paper across a counter, we expect that the value stored inside that payment method will buy a comparable amount of goods in the future. That expectation is the true foundation of modern finance. The technology of money might improve, but the trust it relies on does not get replaced by speed or convenience. This is why the lessons of history matter in today's financial environment. When we look at the stock markets of Weimar Germany soaring at the peak of hyperinflation, it reminds us that rising prices do not automatically mean rising wealth. It teaches us that numbers can lie if we measure value only in a declining currency. When we look at France issuing land-backed paper that later collapsed, it teaches us that even real assets cannot support a currency if issuance becomes reckless. When we look at Rome silently diluting silver content, we realize that slow devaluation can be more dangerous than sudden collapse because people accept it for years without understanding how fast their purchasing power erodes. The modern world is far more sophisticated, but the vulnerabilities are familiar. Today, global markets treat money not only as a medium of exchange, but also as an investment vehicle. People buy bonds, stocks, and property not only for profit but to escape the quiet erosion of purchasing power. Central banks are expected to manage inflation, support banking systems, stimulate growth, and rescue financial markets when crises appear. Governments borrow trillions without needing to raise metals or seize land. They borrow because global investors purchase their debt, trusting that the system can continue indefinitely. This creates an environment where money and debt become two sides of the same coin. Every new dollar issued often arrives as a loan, and every loan becomes a promise of future money. For most of modern history, the United States dollar has been the backbone of global trade, finance, and reserves. The world accepts dollars with confidence because the United States has the largest economy, strong institutions, powerful military alliances, deep financial markets, and a long record of honoring debt commitments. But even these strengths operate within a system built on belief. The dollar is powerful not because it is backed by metal, but because the world uses it to price oil, commodities, transportation, technology, bonds, and international trade. Demand creates value. If the world needs dollars to buy oil, settle contracts, or invest in markets, the dollar remains strong. The system's strength is not physical, it is networked. It is rooted in global reliance. This network effect is what makes modern currency more resilient than ancient systems, yet also more sensitive to shifts in global trust. If a single city lost faith in Rome's currency, Rome could still function as long as other provinces believed in it. If one empire valued the British pound less, others could still hold British financial assets. Today, however, global finance is interconnected. If confidence in a major currency weakens at the international level, capital can move instantly through digital markets. Unlike the past, where gold had to travel by ship or caravan, modern capital moves at the speed of light. This speed creates both stability and instability. It stabilizes strong currencies because capital flows toward them quickly in crisis. It destabilizes weak currencies because capital flees just as quickly when doubt appears. When people misunderstand this, they often focus only on inflation rates, GDP growth numbers, or stock market activity. They see markets rising and assume wealth is growing. They see government bonds being purchased and assume debt is safe. They hear central banks carefully manage interest rates and assume the system is under control. But markets, bonds, and central banks do not create value by themselves. They redistribute value from one group to another. When interest rates are kept low to stimulate growth, savers earn less. When inflation rises quietly over years, wages buy less even if salaries appear higher. When asset prices surge because the money supply expands, the wealthy may get richer on paper while everyday expenses rise faster than most incomes. One of the most powerful illusions of modern finance is that rising stock markets are always a sign of prosperity. In truth, they can sometimes be signals of monetary dilution. If more currency enters the system, the demand for assets that hold real value increases. Stocks, real estate, commodities, and scarce goods rise in price even if their underlying productivity does not improve. People do not buy these assets only to grow wealth. They buy them to protect purchasing power. Investors do not pile into stocks because they think every company will generate more profits, but because they fear holding cash that quietly loses value. The economy appears strong because financial markets are rising. Yet many households feel poorer when buying groceries, paying rent, or saving for the future. Another illusion is the belief that government bonds are always safe. Historically, bonds were considered conservative investments because they paid interest and protected principal. But in a system where debt accumulates faster than economic output, bonds transform into instruments that transfer value from the future to the present. They are tools through which governments borrow purchasing power from tomorrow to spend today. When interest rates rise too much, governments must use tax revenues or new borrowing just to pay interest on previous debt. When rates stay too low, savers lose purchasing power. Neither situation represents true safety. It is simply a shifting of burden from one group to another. In this environment, central banks become managers of time. Their decisions push consequences into the future or pull them into the present. When they print new money or purchase bonds through quantitative easing, they lower borrowing costs and prevent markets from collapsing. This protects the economy in the short term but increases future inflation risks. When they raise interest rates aggressively, they protect the value of the currency but risk slowing growth, increasing bankruptcies, and shrinking investments. Central banks are not villains or saviors. They are institutions forced to balance problems that cannot be solved completely, only postponed or redistributed. Their tools can prevent catastrophe but cannot eliminate the fundamental pressures created by debt, spending, and political demands. Modern consumers feel these pressures without necessarily understanding them. They notice that saving money becomes harder, home prices rise faster than wages, and long-term security requires more than simply earning a paycheck. Young generations discover that their parents bought homes with less effort, and older generations worry that retirement incomes buy less over time. These are not random struggles. They are symptoms of a system where the value of money depends not on metal or scarcity, but on constant management and global confidence. When people lose faith in management, they begin seeking alternatives, even if they continue using their national currency for everyday needs. Some look toward real estate. Others buy stocks, commodities, gold, or foreign assets. Some explore digital currencies, believing that decentralized systems might escape political influence. Whether or not digital currencies survive long-term, their existence reveals a growing desire for money defined by rules rather than authority, by scarcity rather than policy. In this way, cryptocurrencies act not only as assets but as cultural reactions. They represent dissatisfaction with the idea that value should depend on decisions made by central institutions. Yet it is important to understand that the modern world cannot function without managed currencies. No large economy can operate solely on metal-backed money or decentralized digital systems. The volume of global transactions requires flexible monetary policy, credit creation, and debt markets. Modern finance demands the ability to adjust interest rates, stimulate growth, and respond to crises with speed. For this reason, fiat currency is not inherently flawed. It becomes dangerous only when discipline fades, when governments rely too heavily on debt to solve political problems, and when citizens assume that value is guaranteed simply because it existed yesterday. If we compare today's financial world to the historical examples of Rome, France, Britain, and Germany, we find both similarities and sharp differences. We no longer live in a world where metal scarcity controls money supply. We live in a world where belief in future economic productivity controls money supply. The gold cover ratio now serves more as a symbolic reminder of how detached currency has become from physical reality. It shows how much our wealth depends on institutional stability, international cooperation, and responsible governance. It also reminds us that the more a nation expands its claims on future productivity through debt, the more sensitive it becomes to shifts in confidence. The lesson is not that modern systems will collapse the way ancient systems did. The lesson is that modern systems depend on managing expectations. They depend on the willingness of citizens and investors to accept debt as a foundation of value. They depend on the belief that problems resolved through borrowing today will be solved through productivity tomorrow. If productivity falls short, debt grows faster than output, and confidence must carry more weight than real value. This burden on confidence accumulates quietly, year after year, until a point where people begin to question how much future growth can realistically pay for promises made in the present. At that moment, money begins to change roles. It no longer acts like a store of accumulated effort. It becomes a medium of exchange used quickly to escape depreciation. People still accept it, but they do not trust it to guard their future. They use it to move into assets that stand apart from policy, politics, and debt cycles. When this shift happens at scale, the function of money evolves without the need for collapse or chaos. Wealth remains in the economy, but it changes hands. Those who hold assets that maintain value through uncertainty gain purchasing power, while those holding only currency or long-term promises lose ground slowly, then suddenly. This is how financial history progresses, not through instantaneous disaster but through gradual rebalancing. Value moves from those who depend on currency to those who depend on scarcity, productivity, or independence from policy choices. Money continues to exist, but its meaning shifts, and the lives built on outdated assumptions must adjust. That adjustment is the real transformation. Currencies do not die when paper loses value. They die when citizens stop believing that the paper represents their labor. Real money, therefore, is not defined by what governments issue, but by what people choose to rely on when uncertainty grows. In the modern world, money is no longer a weight of metal or a stamped piece of silver resting in a merchant's hand. It is a digital entry, a legal promise, a social agreement, and a tool controlled by institutions that operate on a global scale. Our currencies exist not as physical objects but as measurements of trust. We receive salaries, store savings, invest in assets, and exchange value through systems that depend entirely on cooperation between governments, banks, corporations, and citizens. This cooperation does not come from force. It comes from the belief that tomorrow will behave predictably enough to justify the value we hold today. If we look closely at the way modern money works, we notice something remarkable. Every dollar, euro, pound, yuan, and rupee is simultaneously a claim on goods and services and a piece of someone else's debt. When governments issue bonds, when companies borrow to expand, when consumers take out loans to buy homes, the financial system grows by expanding promises that must be fulfilled in the future. The currency we use becomes the representation of those promises. Your savings in a bank are not gold sitting in a vault. They are part of a system of circulating claims. The financial world functions as an exchange of obligations, each one relying on production that has not yet happened. This structure works when productivity grows, when economies innovate, when industries stay competitive, and when citizens and companies continue to generate value. Growth validates debt. Innovation validates borrowing. Increased production turns future promises into reality. In that environment, trust is rewarded, and money retains its ability to store effort over time. The problem arises when obligations expand faster than real productivity. When governments borrow faster than the economy grows, when spending outpaces revenue for too long, and when debt must constantly be refinanced rather than repaid, the currency begins to depend more on expectation than on output. Money still circulates, but it reflects belief more than achievement. Most citizens do not see this shift because they live within the system, not above it. They work, they save, they spend, and they assume that money will preserve their labor. They notice prices rising, but they are told it is temporary or manageable. They see interest rates move up and down, but they do not see how those movements redistribute wealth between borrowers, lenders, savers, and investors. People feel the results of policy without realizing they are experiencing the consequences of debt and dilution. Their relationship with money changes without anyone announcing the change. They adapt to the new rules without knowing that the rules themselves were altered to keep the system functioning. This adaptation leads to subtle behavioral shifts. People begin to spend faster because they feel that saving in currency alone is no longer as rewarding. They look for assets that exist outside the realm of policy. They buy real estate not merely to live in, but because it holds value better than cash. They invest in stocks not because they believe every company will grow, but because they fear the alternative of holding money that quietly loses purchasing power. They buy commodities, precious metals, or even digital tokens not because they want speculative profit, but because they want independence from decisions they cannot control. In this way, money becomes a bridge rather than a destination. People use it to escape instability rather than to store value. Governments and central banks understand this behavior more than the public realizes. They know that confidence must be maintained not by force, but by policy, communication, and reassurance. They know that if citizens lose trust in the value of their currency, no legal declaration, no digital system, and no promise can guarantee stability. For this reason, modern institutions present themselves as protectors of money while simultaneously using tools that reshape its value. They raise interest rates to fight inflation, but only after expansionary policies helped inflation take root. They increase government spending to stimulate growth, even when debt is already high. They create digital payment systems to increase convenience, while also increasing control over how people use their funds. These actions are not conspiracies. They are strategies to maintain balance in a system that increasingly depends on managing expectations rather than fixed backing. One of the clearest examples of this new era is the rise of central bank digital currencies. Unlike cryptocurrencies created by private developers or decentralized networks, central bank digital currencies would be controlled directly by state monetary authorities. They are presented as efficient, safe, modern alternatives to paper money. In reality, they reflect a shift from currency as a private right to currency as a programmable tool. A digital currency controlled by a central authority could, in theory, be regulated down to the precise conditions under which it can be spent. Transactions could be approved or denied automatically. Negative interest rates could be applied to savings without consent. Stimulus payments could be issued with expiration dates. Financial behavior could be shaped not through policy suggestion, but through code. This potential is not inherently good or bad. It depends on how it is used. The same technology that could enforce spending controls could also prevent fraud, reduce tax evasion, and protect people from bank failures. It could eliminate the need for intermediaries, reduce transaction fees, and provide instant nationwide payments. But it also introduces a form of financial centralization more powerful than anything seen before. Digital currency places the ledger of value in the hands of institutions that already influence money supply, debt markets, and financial stability. For citizens, this means that value becomes not just a matter of economics, but of compliance. Money remains accessible only if one remains within the boundaries of permitted behavior. This is not a prediction of doom. It is an acknowledgement that money is entering a new stage in its evolution. In this stage, scarcity is not defined by metal, but by regulation, software, and policy. Value becomes not only what you hold, but what you are allowed to do with it. The future of currency will be shaped not just by inflation or interest rates, but by control mechanisms built into its digital structure. In this environment, the meaning of wealth changes again. Wealth becomes not a pile of currency or digits on a screen, but access to assets that cannot be diluted, restricted, or reprogrammed. It becomes ownership of things that produce value independently of policy decisions. Some people will hold stock in companies that create goods people will always need. Others will own land, whose utility cannot be erased by monetary systems. Some will store part of their savings in precious metals, not to speculate, but to maintain independence from financial engineering. Some will invest in knowledge and skills that cannot be taken away. Others will choose digital forms of value that operate outside traditional banking systems. All of these decisions reflect a single idea. True wealth is not money. True wealth is control over your future purchasing power, regardless of how the rules of money change. The system we live in is not collapsing, it is transforming. And in every transformation, value shifts from one group to another. Those who understand the nature of value adapt early and maintain purchasing power. Those who assume that currency will always work the same way often find themselves working harder to stand still. Historical transitions show that wealth is not destroyed, it is transferred. It moves from holders of promises to holders of assets. It moves from passive savers to active participants. It moves from people who trust the system blindly to people who understand its mechanics. This understanding is not a call to fear. It is a call to awareness. You do not need to predict economic crises, abandon your currency, or wait for collapse to secure your financial future. You simply need to recognize that money is no longer the destination of wealth. It is a tool for accessing value that must be chosen wisely. You do not protect yourself by running from the system. You protect yourself by thinking beyond it. You protect yourself not with panic, but with clarity. In the end, dollars, euros, yen, pounds, and yuan will continue to circulate. They will continue to serve as mediums of exchange, ways to pay bills, tools for business, and units of everyday convenience. But the people who thrive will be those who understand that currency alone does not store wealth. The real store of wealth lies in ownership, productivity, freedom of choice, and knowledge of how value moves. Money is not what preserves your effort. It is what connects your effort to something that endures. Once you understand that distinction, you stop asking whether money will survive and start asking how you can position your life so that its value remains secure, regardless of how currencies evolve. In that shift of thinking, you gain control not just over your finances, but over the future your labor is meant to build.